Let's talk about the role of central banks and bubbles in terms of the implications for your personal finances, your building wealth, your earning income. For a long time, we've had governments pursuing these easy money policies. Now, of course, there's a challenge. First, before I even get into this, how do you define easy money? Is it excessive creation of M1 and M2, different measures of the amount of money being supplied? Is it measured by whether governments are holding interest rates artificially low? All the people who focus on monetary policy, and oh, by the way, I'm not one of them, but I follow some of them, they say, well, the big thing governments do now isn't necessarily buying and selling government securities, which historically has been one of the main ways they try to influence interest rates. Now it's whether or not they're charging interest on excess reserves or giving interest on excess reserves when financial institutions have to hold reserves at central banks. So there's a lot of complications when looking at things like, how do you define what is an easy money policy? But it's one of these things like you sort of know it when you see it. And when you have interest rates being held artificially low, goosing financial markets, goosing housing markets, you can create bubbles. And we saw a very painful example of a bubble back in 2008 with the financial markets crash that basically spread all over the world. But I think the United States bears a lot of the blame for it because we had very low interest rates goosed by the Federal Reserve or monetary policy agency in the United States. And then we had these government entities, Fannie Mae and Freddie Mac, that in effect were creating conditions for a housing bubble by making it so that any loan you gave to a non-credit worthy borrower, you could still make money on. So it shouldn't have been a surprise that we wound up having a housing bubble and a financial bubble, and then we got the crash. But financial bubbles are just one part of how you can see easy money policy affecting an economy. You can also just have system-wide rising prices, sort of the at least in the United States context. You think about, say, the 1970s with high levels of inflation under Jimmy Carter and stuff like that. And it looks like now in the United States, we might be getting both of those things because all of a sudden consumer prices are going up. At the same time, we have this sort of turbocharged stock market, but is it really turbocharged if it's just the result of a bubble and that bubble isn't stable? And so the reason I bring this up is because the sugar high is nice. It feels good to be in a bubble when the bubble is expanding. But when the bubble bursts and you have a sugar crash instead of a sugar high, this is where as a person thinking about how to build your wealth, you have to think, well, do I save and invest? Do I invest more than stocks? If it's 2007 and you decide to all of a sudden put all your money in the stock market, that might not be a bad idea if you're taking it all out in 2009. Now, however, if you put your money in 2007 and then you rode through the financial market crash and then you've been part of this new bubble being created, you're much better off. Now, at some point, there may be another crash, but over the long run, in general, as you sort of factor out these government-caused boom-bust cycles, in the long run, it's still probably sensible to invest in equities to build your wealth. But you do want to be cognizant of the fact that there may be bubbles, which of course is probably a good argument also for diversifying. Because if you put all your, what's the old saying? Don't put all your eggs in one basket. If you put all your investments in one stock, sometimes companies do suffer catastrophic declines that they never recover from. So as I said already, I'm personally a fan of index investing. Now, having said that, if I had been smart enough to invest all my savings in Apple over my lifetime, I'd be better off today, but I just don't trust that I have that specialized knowledge to have made that decision. So what's the bottom line? What are your self-protection strategies from bubbles? Well, as I already said, it's fun to be in the bubble when it's blowing up, well, expanding, but it's not fun to be in the bubble when it blows up in the sense of bursting. And what if there are rising consumer prices? Could it be that you get on a treadmill where it doesn't matter if your income's rising 5% a year, if inflation is 10% a year, if your financial assets are growing 8% a year, but inflation is 12% a year, how do you protect yourself from that? Do you buy gold? Do you buy real estate? Those are different things people talk about. As I already said, I'm not smart enough to make those judgments myself. I don't know how to time a bubble. I don't know how to get in when the going is good. I don't know how to get out when it's time to escape. So I just do long run investing myself in diversified index funds because that's all I think I am capable of doing. Everyone has to make their own choice whether or not they think they have some special skill that enables them to time the market, to pick the market,